This is episode 56 of the More Doors podcast. We are here together the day after the big Fed announcement, which we're going to talk about in depth. We'll be back with all our opinions on the topic right after this. All right, everybody, welcome back. It is episode 56 of the More Doors podcast. It's a glorious day out in Dallas. The heat's broken a little bit. I'm here with my very handsome and intelligent co-host. How we doing, boys?
We're all here.
We're all here. It's like a reunion.
Physically, anyway.
Yeah. Mentally, we're somewhere else. For sure.
Mentally, we're always somewhere else.
He's having visions of Vegas already.
Oh, man.
When do you leave?
Tomorrow morning.
Nice.
Yeah.
I was supposed to go.
I know. Nick acts like something happened in his world that he couldn't go. He's like, I was supposed to go, but then I decided not to.
No, you know what really happened is I do coach my son's baseball game. And so then I'd have to leave in the afternoon on Saturday. And then would I come back Sunday or Monday?
Yeah, that's not really fun.
Yeah.
Getting to Vegas and only having a little time when everybody else is still there isn't that's not as much fun.
Definitely not.
We're doing Circa.
Uh-huh.
And so our friend whose 40th we're celebrating is, this is a little bit of an insight into how his mind works. His 40th birthday is not for another month. But the reason that we're going now is because he is a diehard Texas Longhorns fan. So much so that he refuses to go to Vegas on his actual 40th birthday because the game that Texas is playing is too important that day. They're playing a no-name school this weekend. So he's comfortable watching that with his friends while having fun at the pool and not getting too emotional. So we're going this weekend because the stakes are much lower.
Can I be honest? That sounds like an ass-backwards reason. You would think you want to be there for the best game.
He doesn't bring his best self to the best games.
No, he doesn't.
Does he just want to see Arch Manning on the big screen? Is that it?
Yes.
Yeah, I'll get a full taste of him this week.
That's it.
Well, look, today's show is sponsored by not just Archie Manning. Is it Archie? That's his dad. Arch is the son.
Archie Bunker?
Archie's the dad, I think.
No, Archie's the granddad.
Well, one of the dads.
The father of the father.
Yeah.
Because Arch Manning is the oldest son's kid, right? It's not Peyton or Eli. It's the other one, Cooper.
Who was actually they say he was the better
say he was the
athlete.
best.
Better one.
Yeah.
They say.
We'll see. We'll see how it plays out. But look, today's show is brought to you by Deep Blue Capital. If you're like the Mannings where you got to go invest your money, right? You need the tax write-offs. They're investing in projects left and right. Not with us. Just full disclaimer, disclosure. Not yet. But what you can do with that is invest with Deep Blue Capital. Sign up for our investor newsletter. We're looking at several deal flows right now, or deal opportunities at the moment. So you want to get in on that. And I know that a lot of the brokers are giving Matt a call because they're saying, hey, we've got a good opportunity for you guys to invest in. We want Deep Blue and their investor group to take a look at this. All you have to do is go to deepbluere.com, sign up for that investor newsletter, and then you're going to get a call and text from me. So who doesn't want to talk to me?
Get a lot of early looks. A lot of looks. And then go on over to TORE Studios. Excuse me. Wow. Sorry. It's TOREstudios.com. Jesse, if you could edit that out or just leave it, whatever.
I'm going to leave it.
That was a coffee burp. Ugh. TOREstudios.com, TORE Studios, the home of Jesse Strohwalter and TORE Studios. This is a sidebar. It has to do with TORE Studios. Jesse has a monitor up that we can see, but it also runs off of his MacBook. So I can see he has 20 missed FaceTime calls, which is an odd number of FaceTime calls to have missed. Who's FaceTiming you?
I think that's just, I guess that's just calls. I don't know, actually.
He's so popular.
Yeah,
he gets blown up on FaceTime.
Yeah, but I never really check it on. I never really check it on my
It's
computer.
the beard.
It is.
Really
You want to get some FaceTime with Jesse. That's funny. So check out TOREstudios.com for all your multimedia and content creation needs. Boys, I'm a little stuffy. My voice is extra low today.
It is.
Big day yesterday.
Big day yesterday.
Me and Jesse were debating this back and forth down to the wire. I thought quarter point. We both did.
You know, I thought so too. There was, it seemed like the last 3 or 4 days leading up to yesterday, there was a lot more chatter about being 50 bips. And like into Tuesday and Wednesday, there was kind of growing voices out there about them not cutting 50 because it would look like a desperate move. But I think that honestly, I think the election had a little.
That's
to do
what
with
I was going to say. If you really kind of break this down a little bit, is there some
Yeah.
influencing going on?
You think so?
Yeah, I personally think so.
I'm glad you're not a conspiracy theorist either.
I'm not a deep conspiracy theorist, but there's some look, I'm going to tell you right now, some of those what was labeled as conspiracy theories came out to be true
I got you.
during all that. And it just, again, why would they go to a 50 basis point cut? If the economy is not, if the economy is going well enough that the way they're saying it's not bad, why would they do a 50 basis point cut? Right? No one talks about those job revisions.
That has been very, very quiet. What is it? There was 800,000
went from 2.9 to 2.1 million.
Wow.
That's a 30% drop. That's huge, right?
No one talks about that, right? So again, when we look at this, the economy is not going as strong as they're saying it is, or even with inflation supposedly coming down.
Right.
When you look at this as a whole, I think that some of this is politically influenced. I think the rest of it is they're saying, hey, things aren't looking great. Mm-hmm. And what also concerns me, because Brian and I are both in the residential real estate space, the amount of excitement coming from real estate agents is it goes to show that they don't understand the way that this works at the highest level.
Yeah, that was really, we had a whole call with our team about it yesterday around why Treasury yields were flat and actually increased a little bit after the rate cut, because the based on trajectory, and that was already baked in. So you had a 0.5 point rate cut, but the 10-year Treasury actually went up a little bit. Mm-hmm. And my thesis around that was over inflationary fears, meaning if that half point cut signal a little bit more urgency on the part of the Fed. And are we not going to see inflation keep coming down in a straight line? Will we actually see a little bit of inflation tip back up for a little while? The analogy I used yesterday was the Fed is kind of sitting on top of the horse right now with the reins, and they got to figure out exactly how much slack to let out and pull back. And it's not going to happen all overnight. But I think that one of the reasons you saw Treasuries potentially go up is because of exactly what Nick said, meaning the 0.5 point cut might have signaled a little bit more urgency on the Fed's part, which means maybe bonds is where some of the safe money went. And so maybe Treasuries ticked up because of that. Regardless, I think when you take in jobs revision, the fact that we're cutting rates really, really quickly, or a lot more quickly on that first cut than we were talking about, and then Jerome Powell's comments, which are normally very hawkish to the standpoint of they put the markets in a little bit of a fit, or have, as of late. The markets reacted very well to his comments, but I don't know necessarily if that means that we're on a stable footing as the Fed wants us to believe. I think that we're possibly not going to be realizing the soft landing that we're talking about. If you look at a lot of really fundamental metrics like the yield inversion curve, or the yield curve inversion, over 700 days, Jesse?
Correct.
We're basically undefeated in inverted yield curves that deep for that long and that wide, I guess, that don't lead to pretty impactful contractions in the economy. And my thought is maybe the Fed made this cut because they realized they waited a little too long, and now they know it's going to be a hard landing, and they want to get ahead of it.
Yeah. It's funny you should say that, because that kind of segues into a point I wanted to discuss with you guys. So there's been 3 50 basis point cuts so far this century. First one was January 3rd of 2001. After that, the S&P fell 39% over the next 448 days, and unemployment rose another 2.1%, and we were definitely in a recession. The next one was September 18th of 2007. Well, after that, the S&P fell 54% over the next 372 days, and unemployment rose another 5.3%, and we glided into recession. So in 2001, right, you had the dot-com bubble, right? That was a big catalyst. Companies were just imploding everywhere. I was working on Wall Street at the time. It was terrible, right? 2007, we were in The Big Short, living through it, right? And honestly, like, I think that actually the 2007 cut, that was still a year ahead of when it got really bad. I bought my first home in May of 2008, and I remember I was on a fishing boat watching the market destroy itself. Yeah. And, Bear Stearns went bankrupt, like, as I'm out there fishing. I didn't know what I was coming back to land to say. I thought Wall Street was going to be on fire, right? But here we are now. What does history repeat itself out of the last two times, or what?
I mean, would we go back and say, if you kind of look at the last year alone, do we feel that we are already in a recessionary trend?
It's funny you should ask that question. So I was on a panel about a month ago, and that same question came from the crowd. And I said, I really do believe that we're already in a quiet recession. The guy next to me who runs a family office, he's like, I disagree. It takes 3 consecutive quarters of negative GDP growth, blah, blah, blah.
I thought it was in order to be
2, 3, whatever.
Well,
right?
We change things just depending on whether or not we want to be in a recession.
Exactly.
Move the goalposts.
But I honestly think that the definition of certain market conditions needs to change as market conditions change, right? And a definition of a recession that's 100 years old may not necessarily apply right now. And speaking practically about real estate, we own a lot of workforce housing, right? Those folks are hurting, right? A lot of them are like one flywheel away from not being able to pay, right? And we're seeing, a lot of concessions need to be offered in order to get people to move. Rents have been pretty stagnant, right? Our bad debt allowance has gone up. Our vacancy has gone up a little bit. And I think that kind of part of the market where the pyramid shows that there's a lot more population than at the top is really hurting right now. And I think we're in a very quiet recession.
I agree with you. And that's the point is, like, I don't think the recession should be general, like you said. It's not either all or nothing. Right. It is for the most part, Americans that would be deemed middle class, when inflation and on just the food increase costs alone, when you're spending more on your food and you can barely pay for everything else. And then of course, housing goes up. Now, whether we can call that a recession or not, I mean, they're making less money. They have less disposable income. Mm-hmm. And the way that I look at it is not from a sense of, all right, are we seeing an increase in unemployment, which we are, but does the average American have more or less money? And right now they have less. Yep. And to me, that's more of the recessionary terms that we should look at, rather than saying 2 consecutive, negative GDP growth. Who gives a shit?
Right.
Like, in all reality, those are businesses. And I think that's more for the government to figure out how much money that they're going to try to bring in or what they need to do to change it. But for average Americans, if they're making more or less money, that should be the kind of the trend line of whether we're in a recession or not.
You're not one. I think you hit the nail on the head that the 2 consecutive quarters of negative GDP growth is kind of an antiquated and a very base level. Like, we're in a recession if this happens. We live in a much more nuanced global economy nowadays. I don't think that's a very good definition. There's this idea I was listening to on another podcast though about trigger points and black swans, right? Meaning going back to the yield curve for a second here. I don't think that that's necessarily I think that's a very good indicator, having an inverted yield curve for this long, that something is looming. We've seen inverted yield curves before briefly that don't turn into much, but one that's been inverted for this long and by this much, there's never been one that didn't precede a recession and a pretty substantial correction in the markets. But what is the black swan, right? Meaning, it's really easy in hindsight to look back at all the factors that caused the Great Recession, and you go starting with, you got to feed the mortgage-backed security machine by starting to make worse and worse loans, and then find ways to give people, more cheap money to keep feeding the machine. And then you get into the everything from the synthetic CDO space to, pay for play ratings agencies, all kinds of stuff. And it's easy to look back and go, wow, like that was the black swan.
Right.
But when you stand really close to the mirror, you think that the music's never going to stop. I don't know necessarily what the black swan here is, other than that we gave people a lot of cheap money for a really long time. And then not only did we stop, we revved up rates at 100 miles an hour, which totally threw things into a state of flux. And now we have very little really good data, I think, on where the economy stands. The jobs report is a great example of that, right? There's a significant difference in 2.9 million jobs created and 2.1 million.
Yeah.
And I think that somebody had mentioned this on CNBC yesterday, we're not really in any part of the known economic cycle, I don't think. I think that what's happened over the last several years is we have pulled so many levers and so many variables have come into play, everything from COVID and supply chain issues and shocks there to cheap rates, free money, all the way revving up to expensive rates, what that did to housing, and now the delta in housing affordability versus wages and things like that. I don't know that we're in a predictable part of the economic cycle. And so I don't know that necessarily we have an understanding of what the trigger point will be for a massive correction, or even that there needs to be one. We might just be off in no man's land economically right now. And I think that if that sentiment starts to creep in, I think there's a sentiment-based recession that we go into because people are just realizing that the economy is a bit of a house of cards right now.
Yeah, and that's something that I've spent a lot of time on, right? Especially as I was kind of going through that point that I made before. To your point, there were big catastrophic issues, right, that were happening in 2001 and 2007. The things that come to my mind right now is it something unknown? Do we have some sort of unknown geopolitical risk, right, that could force a hard landing, right? Is it the credit card default rate that's going to sneak up on everybody when all of a sudden they're paying 25 and 28% on their credit cards, when we just talked a few minutes ago about them feeling penny pinched because of the groceries and just the cost of living has gone up, right? I don't know what it is. And part of me says I hate to figure it out because nobody sees it yet.
Right.
But it also gives me hope that because there's no known catalyst at this point, maybe it does set us up for a soft landing when we just kind of need to flush this out. Because to your point, the last 5 years have been unprecedented between COVID, right? And now this. Is this how we break the trend because we just kind of need to figure it out and weather the storm?
Yeah. Well, and this goes to a little bit of a different thesis, which is being in unknown territory means we might have outcomes we've never necessarily seen before. And so the other point to this is without a really solid trigger point, there are some very scary statistics in the economy right now, right? The record number of people paying the penalty to take early 401k jobs to pay down credit cards is a very scary statistic.
Want to pay their housing
and housing, right? Obviously, taxes and insurance, right? So there's a lot of scary things happening right now. There might not be one catalyst, and my bigger fear around the economy right now is not actually a massive correction. It's a long period of stagflation, because we may have gotten ourselves into a situation with really low rates to really high rates really fast, and then a lot of artificial money essentially pumped into the environment. It might just take a long time to unwind and get back to a state of normalcy. And I don't know if that's necessarily better or worse than a true recession, but we went through a period of this, if I remember correctly, in the 70s. You had higher unemployment and inflation, and it just took a long time for things to work themselves out. That might be where we're headed as well. And I don't.
It's a shame none of us are old enough to know.
Yeah, I mean, if we look at. And you're right, Brian, like how we look at this is right now, it seems like the only lever that anybody's willing to look at and be pulled is the interest rate lever. And I don't think that should have been, I was just kind of researching here, first off, during the 2008 recession, if we look at the hard recessions versus soft landings, like in 2001 and 2008, there was reasons behind it to make it hard, right? There was the dot-com bubble. And then we had the financial collapse, and what would be this one? Some of the things that come up is there going to be a collapse through maybe natural disaster and insurance companies can't pay out? When we kind of look at a lot of that, do we see something happening where now state and federal governments have to pick up those pieces, and it devastates the entire economy, United States economy, because it just puts it at a standstill because we see maybe a collapse in insurance companies. But I looked at, all right, who made money during the 2008 collapse, right? And it was talked about the group gold and precious metals made money, the U.S. Treasury bonds, consumer staples like food and beverages, household products, personal care, and then healthcare saw a decent increase during that time. And so there's, even during recessions, what I don't want to do is fear people away from even thinking about continuing to invest, right? All we hear is the negative side. And, before the show, we were having an 1.5 hour long conversation about, deep blue capital and investment opportunities. And we do believe now is that one of the best times to go ahead and continue to acquire assets. Mm-hmm. Now, is it fun to hold and manage it right now? No. It's definitely a lot more work. We have higher delinquency. We have occupancy issues. We've seen people buying on short-term debt and financing that's come back to bite them and their investors, in the rear. And the way that I see this at the moment is, Americans are making less money. So in 2024, Americans are facing mixed conditions when it comes to disposable income. We've seen a nominal disposable personal income growth, but that monthly increase is ranging from 0.2 to 0.5%. Mm-hmm. But because of how much inflation has increased over the cost of just running your house, of the necessities you have to have, right? So it says real disposable income growth has actually turned negative for the majority of Americans. There's a few higher income households that are kind of staying flat, but until that is under control, it doesn't matter whether we have high or low interest rates.
I agree with that,
and that really speaks to a little bit of the vortex we might be facing. Is we go into a situation with higher unemployment, which I think the jobs revision shows that we may be headed there. Now, jobless claims were a little bit different this morning, which, again, this goes back to I don't think we have really great data on where exactly we stand.
You can spin data however you want.
That's what I'm saying.
Support your narrative,
right? I the feeling I'm getting is that unemployment is higher than we think it is.
I agree.
And so higher unemployment leads to a more competitive environment for hiring or for those available jobs. And so that means that we usually don't see higher wages. You don't see high unemployment and growing wages at the same time. And so if disposable income on an adjusted basis is actually already negative and we're in a higher unemployment rate or environment than we think we are, there's a really good chance that delta will increase.
I agree. And I think it's also really important to keep an eye on the headlines that are still out there about big companies still announcing layoffs, right? Like one of the big consultancies came out last week and they announced a almost 2,000 person layoff in the US, right? And this is a marquee name in the advisory space. And most of those layoffs happened in what 3 years ago was one of their biggest profit centers. So they're not just looking at their business at the moment. They're looking at the pipeline, the financial metrics of this business, probably a few years worth of projections and figuring out that they're overstaffed by 2,000 people. That's a lot, right? I think one of the other potential black swans, and I don't know, people probably don't want to talk about this, is 2001 was the .com bubble. But are we seeing the AI bubble right now? Right?
Not everybody's going to win. So
yeah. And there's going to be consolidation. People are going to, just like how technology was in the early 2000s and 2010s, where they're buying companies for patents and then just laying off the people.
Yeah.
Right. I mean, that's how really the .com bubble started to get catalyzed.
And I think that's a very good point, especially with the the hiring run up that kind of built this potential AI
Yeah.
bubble, you're starting to see a lot of layoffs of those same
Well, it's
companies.
both. So again, if we look at this, we have right now the expected job loss in 2024 in the tech sector alone is $130,000 tech jobs were projected to be lost due to automation and economic shifts. Some of that has to do with AI replacing some of it. Some of it has to do with kind of the I don't think we've seen the AI bubble burst yet. I think that starts to happen in maybe next year or in 26.
Yeah.
And retail and consumer goods, what we saw, or financial services, Citigroup is expected to cut 20,000 jobs over the next 2 years as part of a long-term reduction strategy. So when we look at it, why do they lay people off?
Yeah,
They're
when you
doing-
look at companies that have like the most data and people that are
Yeah,
that are
they're doing
full-time
it.
just
They're
trying
doing
to-
it to lower expense load and to bolster cash to get through tough times. And so when we look at a lot of this, media companies such as Pixar, Comcast, and Paramount Global have also announced layoffs due to changes in the industry. You've got the Congressional Budget Office is projecting unemployment to rise to 4.7% by the end of 2024 before stabilizing in 25.
Well, it's 4.7%, you said?
4.7.
So they're saying it's 2.1 right now.
Yeah, exactly. And there's no way it's that's true. If you just look around your world, it's not 2.1.
Right.
You know? I mean, we don't know everybody, but it's not 2.1.
I know enough people that have had job layoffs.
Yeah, it's not 2.1.
And they're still out of a job.
Yeah.
Right. So I know a lot of those, and I know more people today at whatever we would say the unemployment rate is versus in 08 when I had friends, that was my friends graduating college, just out of college, and they were still experiencing employment. Now they were younger in their career, so they were cheaper than what my friend group is today. But we're definitely at a much higher than that to whatever it is at the moment. And I was listening to a podcast, the All In podcast, and they were talking about, I can't remember if it was Elon or Peter Thiel talking about, why do we not have real-time data on this now?
Yeah.
Like, we're supposed to have all this tech.
Yeah.
And we're supposed to be one of the smartest in the world, but we should have a pulse, a real-time data on the pulse of this, and we don't. Mm-hmm. And just to have a job revision of 800,000 jobs lost, and it didn't get talked about.
Who got fired for that, by the way?
No one.
Yeah.
Nobody.
But it makes perfect sense what Nick's saying, right? That just the fact that every time we hire, we all are employers. Every time we hire somebody, we have to register the payroll, get them on a W-2. There's obviously a database.
Sure,
It
totally.
seems like you'd be able to see it in real time.
Yep.
We figure out our national debt in real time and put it in Times Square.
True story.
You
Good
know,
point. Yeah.
that seems a little more complicated to figure out than how many people have jobs.
True.
It's wild.
So I look at this from a standpoint of are we already somewhere towards that, bottom, or are we close to it? Because when I was selling real estate in 08, and I had clients that were freaking out, like they thought the end of the world was coming. I had lost I had 8 closings in 1 month. They all disappeared. They all died during that collapse.
Wow.
Didn't come back to life.
The
And
deals, not the people, right?
yeah,
Okay.
the deals. And thanks for clarifying. But as we were going through 08 to 11, if you really look at it, we were already out of it in 2011. Now, mentally, people still felt like we were there. They were still acting like it was there, and the just the outlook didn't feel positive. But when you go back and look at our data graphs and the trends, we were well out of it in 2011 and on our growth upward trajectory. And so, now we've been hearing survive until 25, and now is it thrive in 26, or what are they saying?
Yeah, we're right on the cusp of 25, and it doesn't seem like we've seen.
I think ultimately we've seen flat, rental growth and in decline in certain areas. We've had occupancy challenges, and people have to live somewhere. So where are they going?
Right.
It's not like are they staying put and just not paying and waiting to get evicted? There's there's not that much supply that has come on to absorb it all to be sitting at occupancy levels that some of these asset classes are sitting at.
True.
No, you make a really good point. It's been very challenging to figure out what the catalyst is for some of those things. I want to go back to a point you made before about have we seen the bottom. I think a more important question is we look at contractions or corrections or recessions in almost this sort of V shape. If you were to look at it on a market chart, and is this the trough? Is this the bottom? And where do we go from here? There is, without understanding how we get the economic variables to align again, meaning shelter costs, wages, consistency of employment, cost of goods and services, all sort of back into alignment for a healthy lifestyle for the average American. It really doesn't matter if we're at the bottom. It's more how long are we going to be in this particular state? Whether this is the bottom or not, you can stay at the bottom for a while. And I don't think we talk about that quite enough, meaning like we talk about is this the bottom, meaning things should immediately rebound and get better from here. That's not necessarily the case until we figure out how to fundamentally unwind some of the things that are causing a lot of these difficulties in the market right now.
I agree. And I think one of those is spending.
Yeah.
Right? I think we all were way out over our skis on spending.
Yep.
Right? From housing to luxury goods, the whole thing from 21 to 23. And now we got to give it all back, right? Everything.
Even now, though, Jesse, pull up. What was retail spending last week? It came out, right?
Yeah, I think so.
And it was really quickly. We'll do this on the fly, because to that exact point, this is some of the stuff I have trouble figuring out. Is retail spending okay? So retail sales are stronger than expected in August as consumers keep spending.
They're putting it on credit cards, though.
Yeah,
That's
exactly.
the problem.
Yes.
You know, and so how much of this is just human behavior in a strange, like, are we telling people that we're not in a recession enough that they're still spending money?
Think of it this way: you get out of shape, and it's think of the holiday months, right? Typically during holiday months, we give ourselves permission to eat a little bit more. We put on a few pounds. We're like, you know what? Summer bod's coming later. I'm going to enjoy this time. And from 21 to 23, as we were getting, as money was just being injected into the economy and given away for basically free, we got used to having this money come in that we didn't earn. We did nothing to earn it. The savings were at an all-time high.
Yeah.
And then we just started spending.
Mm-hmm.
And during that time we were spending, like, checks are coming in. I'm getting this money coming in. I'm getting this
Free
credit.
money.
Yes. And so we kind of got trained for the last couple of years, and it's hard to get back into shape.
Yeah. No, you're not wrong. I also, to the previous point we're making about inflation, though, is retail spending up as a function of inflation and things costing more?
Yeah, that's what I was going to say.
Right.
And so I also think that August is probably not a great time to pull that data because people start getting prepared for back to school, right? I think there's certain life events that we need to align to some of the stuff.
That's a good point.
If retail spending is up in October when there's really nothing other than Halloween going on, like, that's impressive to me. But like people spending more in August, it says it's up 2.1%. Well, how much is the average pair of jeans up this year compared to last year as people, get ready for back to school?
So this is what it says. The growth is slightly lower than the 3.6% increase that we saw in 2023. And a lot of this is reflecting more because of the continued economic challenges such as inflation.
Yeah. So it's not a measure of the volume of transactions. It's the amount of dollars that have been exchanged, and that is highly sensitive to inflation.
Exactly. Now, I'd like to see that number inflation adjusted.
Right.
If anybody if anybody listening to our podcast is smart enough to figure that out, give us a call and you can be a guest.
Yes. I'd love to have that conversation. So realistically, then, I think that a good thesis is that retail spending is not actually up by not voluntarily up, right? We're paying for the sins of previous years. And while more money is being, and this maybe this is a bit of the black swan, is we've got so many key indicators that look like they're heading in the right direction that we're continuing to tell the American people that everything's okay, when really they're totally getting just pounded.
Yeah, totally.
Right?
Absolutely.
And how long can that go on for before mass layoffs? And this could be the catalyst. And I've talked about this a lot in just in normal conversation on our other show. If you combine the inability of Gen Zers and millennials, millennials specifically are in their prime earning years right now, and housing has become so unaffordable that if they are not already homeowners, it's very, very difficult. And if they're trying to trade up right now because they're expanding their families, it's very, very difficult. If you combine that with the boomers being the largest inventory influx in a century, potentially, of single-family homes ready to come back on the market, well, if they can only afford those homes, if prices come down, then that's a shitload of equity and coming out of the markets, right? And also, if we start talking about layoffs in mass, which might continue to happen, you see layoffs are mostly gonna be targeted towards your entry level and your people who are ready to sunset. Unfortunately, for the most part, that happened a lot in 2008 on Wall Street. Was not just your entry level people, but your very, very, very high paid, already in your probably last 5 years of career. Let's just give you a package and send you on your way so we can free up capital.
I'm sure there's a few HR departments that would disagree with you, but
I'm sure that they're paid to disagree with me. And does that escalate them wanting to unlock their equity while they still can, retire as early as possible? And if the generation below them can't afford homes at the price at which they're trying to get, does that bring prices down? And is that the housing market correction? Because so much of inflation is geared towards shelter costs. Is that the housing market correction that brings inflation down and makes, one, housing more affordable, but brings that more in line with current wages?
Yeah, so I think you're onto something there. But I also think that you're not the only person thinking about that, right? And is lowering the interest rate, starting to lower interest rates back down to 4.5% or 5% compared to 6.5% and 7% where they were a few months ago, is that helping close that equity gap, right? Because if we're buying houses or using money at 4.5% or 5% instead of 6.5% or 7%, you start to see that price appreciation tick back up.
Yeah.
And maybe it's not a wash, but maybe it's not the huge gap that we all think it could be.
Right. Well,
Right.
and that actually kind of stokes my fears around the stagflation scenario, because rates are the most incendiary variable of the three variables of affordability. The three variables of affordability are the asset price, the rate at which you're borrowing the money, and how much money you make, right? How much money do you have to spend on something? How much money are you borrowing and at what rate? And how much does it cost? Rates are the most incendiary because as they come down, it could spark price increases.
Sure.
Now, that doesn't always happen. It certainly didn't happen in 2011 when the rates really had to get cut during the Great Recession because sentiment was so bad that people still thought it was a bad idea to buy a house, even though, years later, it's probably the best time to buy a house. But it is that there is potential for that. And that could make things feel okay for longer in the short term, meaning, hey, rates came down. Now these people that couldn't afford a house anymore can afford a house. But does that quell the long-term problem that rates are just one function of affordability and houses still cost much more as far as the amount of income that you make after taxes in relation to the home prices? Does that actually just kick the can down the road even further?
Possibly. Yeah.
And that's what scares me more than anything is recessions are a natural part of an economic cycle. They're not fun. They're really not fun. They are necessary.
Yep.
To get things back to equilibrium. And so how much worse does this problem get a decade from now if interest rate cuts spur more home buying and drive prices back up?
Yeah, I think it's a good thesis. Here's another thing that I've had a very watchful eye on is this a lot of emphasis lately on return to office, right? And so here's the paradigm that I think through. I think Amazon, just the CEO of Amazon came out a couple of days ago and says, everybody's coming back to the office full time. Okay. Now, Amazon's a very big company, as we all know. However, in my Nick Good conspiracy theorist mindset, I say to myself, and the CEO is like, we're going to go back to thinking like a startup. when we all are on site and collaborating to fix these big problems or big solutions, whatever you said, right? I worry about this for a couple of reasons. Number one, do these big companies see something in their financial modeling that says, holy shit, if we don't get the team back and find productivity increases now, are we going to be in deep shit 9 or 12 months from now? Yeah. And we've got to come up with the next genius idea or the next, great product. And we're only going to do that by bringing people together. Yeah. Right. Or are these organizations under a lot of pressure from the board saying, hey, we spend $400,000 a month for a facility when there's 19 people here 2 days a week.
Yep.
And you guys are either all fired, right? Because we don't want to go virtual only, or we got to find a way to buy out this lease and get out of this contract, which, by the way, would probably result in another layoff because they can't afford it anyway.
They can't afford it.
So and then for the for the employee, now we just talked for the last 45 minutes about how tight things are for people, right? So if you're working for a company and you have kids, and you've been virtual for all or part of the time, and now you're being told you got to come back to office. Now all of a sudden you got after school care and daycare and all the unforeseen costs that you haven't had to deal with for the last couple of years.
Gas, food,
the travel, commute, right? All that sort of stuff. Like, where does that money come from?
Well, I'm sorry. Before I lose this thought, you hit the nail on the head about one. We've stopped talking about the potential looming commercial office space crisis for a little while, but there's also another element to the return to work thing that is exactly what we're talking about right now. If you look at the amount of really outside of potentially the AI bubble, which is a very specific space in the tech industry, there's been such a deceleration in innovation, I would say, over the last few years. People have realized that working from an office, it inspires collisions that inspire collaboration that you don't get working from home.
Right.
And I think that's another aspect of this is a lot of great companies are starting to feel like they've lost their competitive edge because the masterminding that goes on inside a facility when you get great people together, you can't get long-term working from home. And so there's another aspect of that as well. Are companies going, just to like what you said, we're not coming up with anything new, and we have a fear around what that's going to look like 9 to 12 months from now. And if we don't either lay people off because we're just going to commit to what we do well, like didn't Elon say he laid off 80% of Twitter and nothing changed?
Yeah.
Because if you're not trying to do anything new, you can significantly reduce your workforce if you're just going to commit to this is what we do. But if you don't feel like that's a competitive advantage, and you're not coming up with anything new, you do need to get your people back in the office. You need to get them together face to face. That's how cool shit gets built.
I think the conspiracy side of me says that
here it comes back.
Here,
they're putting this mandatory coming back to the office in place only to have people say, I would rather work from home with a pay cut.
For less.
Mm.
Right. I've heard of some companies offering, hey, we'll let you work from home, but it comes with either no more promotion, no more increase in salary, or reduction in pay.
Yeah.
And the majority of people took the reduction in pay to work from home.
What does that tell you? Right?
Yeah. I would tell you that, we've seen that this generation is no longer wanting to just live to work. Right. I think we even talked about this on the show.
Yeah.
Is that they're not living to work anymore. They're wanting to find this work-life balance. They're spending more time at home with their families. They're wanting to travel more. They don't want to be tied to a cubicle. Mm-hmm. And look, we saw that in 2001 when Office Space came out, and the guy was just going insane because of the TPS reports and just being chid. And like everyone, that's the whole reason we get into this is to get out of the corporate grind.
Yeah.
And that's everyone's dream. And so to go back into an office space seems like a beating. You have to follow certain rules. It's almost like you're back in school again.
Yeah.
And so I think that for companies to make that mandatory, I think they're setting it up to say, all right, great, Matt, you don't want to do that. It's no longer coming with increase in pay. Yeah. In fact, it's $15,000 less. Would you be willing to accept that? And you're going to say yes. And now they're still getting people that are going to work. that they're used to having, but they're reducing their payroll expense.
Agreed. So let's go back to your point, though. So if those solutions or those offerings are out there, right, you can stay remote or partially remote, but you're getting a pay decrease or you're not eligible for promotion, which typically comes with more money. So now we're injecting less money into the workforce. And how does that compound the tightness of the economy that we're talking about right now?
Look, it's not great. And I think that it shows the mental, the where we are mentally as a population, that look, we all complain about not having enough money, but people feel that they're overworked, they're overstressed. Look, I read an article in the New York Times the other day about how parents are more overstressed. This generation of parenting is more overstressed than any other generation. It's because we feel that we have to take everything on alone as mother and father, versus before it was a village. You would have family, friends, community help with that. And so we feel like we're not spending enough time with our kids or being present with our family. We have all these other demands pulling on us from a career, to trying to the hustle mode, the grind it out mentality, 24/7 or nothing, 10x it. And so it starts to weigh on everyone mentally.
Yeah.
And it's breaking them down to the point where they're like, screw it. Like, I don't want to make more money. They're just doing enough to get by.
Yeah.
Yeah.
I agree 100%. And going back to what you just said a little while ago around just the idea that in an environment where things are clearly more expensive, but people would still rather take less to be able to they would choose convenience over income. That's not the canary in the coal mine or the black swan, but I think if there's anything to take away from the American zeitgeist at this moment in time, that feels a little bleak. It feels a little bleak that things are already difficult, but you would rather stay home and make less. By the way, I say all of this to say this is kind of been a little bit of a bleak conversation at times. From an investment thesis standpoint, I do believe this is part of what turns us into a society of renters at some point. And so, multifamily is probably a great space to own assets in. Yeah. But does that really feel like a concerted effort on the part of a small constituency of decision makers to really pound the American people into submission a little bit?
Yeah, and look, I think that there's always the devil's advocate side of this conversation where not all companies are doing this, and the entire workforce is not necessarily susceptible to this. And sometimes we only know what we see the headlines about. So I'm sure there's still plenty of companies where virtual first and no RTO mandates, but I think it just kind of goes to support what we talked about with income growth or lack thereof and how folks are kind of navigating this economy from a family perspective. But there's still plenty of people that are going to go out there and work their asses off and achieve and overachieve. And there's still going to be families that, maybe the stay-at-home parent can't stay at home anymore, but they go out and figure out a way to have a better life than they ever did before. But, I think that there's just been so many yellow and red lights from an economy perspective over the last few months that kind of led the Fed to making this decision, that it's going to be interesting to see how the result of this really works itself out over the next 3 or 4 quarters.
That in the election.
Right?
Yep. I was flying back from New York in my Uber driver yesterday, and I always bring up Trump because I want to hear how New Yorkers view Trump. And I was honestly shocked at how many are Trump supporters in New York City.
Oh yeah, Ground level in New York is way different than what you hear on
the media, right? And one of the reasons he's like, look, my wife and I do really well. He's like, we make about $300,000. I was like, dang, as an Uber driver, I mean, it's like, all right,
there's nothing wrong with that. Damn.
Yeah, I was like, and he said
maybe OnlyFans too.
Yeah,
maybe so. And he said, look, I have less money in my pocket today making the amount of money my wife and I make combined than I did when Trump was in office. And he's like, I'm voting with my wallet and my disposable income in mind.
Mm-hmm.
He's like, look, I would rather have more money that I could choose to spend on my family or to build a retirement or to get the heck out of New York City to move to Florida, which is where he really wants to be, than to have someone else who's coming in and make the situation in his mind worse. And so I think that the way that we look at it is the election will also speak volumes of where we think the next, at least the next 24 months are going to go before we can figure out what the level playing field is.
True. I mean, I saw Trump all over Instagram yesterday. And by the way, I'm like not trying to bring a political spin to the show because I think we've done a very good job staying agnostic. But like he's talking about no taxes on tips, Social Security. What was the third thing?
No taxes on overtime pay.
Overtime pay.
Yep.
Right? Like those are three pretty significant things for there's a huge food service industry out there, right? And we have a lot of aging folks in the country.
Yep.
Like those are three pretty significant changes if you can actually put that through.
Look, I think it addresses the main problem out there, which is going back to what we talked about earlier, is Americans have less money right now. And that solves an immediate need. And then we've got to fix everything else. We've got to fix government overspending. We've got to fix, we shouldn't be as worried about Fed hikes or Fed decreases.
Yeah, we shouldn't be as susceptible.
Yes, the way that we've been. I mean, up until the massive Fed rate increase, what we talked about was, we can't have money, being borrowed this cheaply, and we would like to see probably a slow increase with the rate. Yeah. And so they had 12 plus years to do something, really 11 years to do something about it.
Well, and don't forget, I think, was it this week or last week was the first time that we went over $1 trillion in
debt repayment.
Yeah.
Mm-hmm.
So
$1 trillion in debt repayment.
So I think that ultimately, while there's hope out there, we got to get through some doom and gloom, and just like anything, when it comes to repairing yourself financially, which is what the U.S. government has to do, there's going to be some pain in it. Yep. And the show about how to get more doors, the opportunity is there as an investor. Yep. And if this sounds like a lot, but you still want to grow in your investment portfolio, you need to do it with experienced operators, hopefully like the Deep Blue Capital team when you vet them out. So all you need to do is go to deepbluere.com. Sign up for our investor newsletter. Let's have a conversation. Let's see if the buy box criteria that we're looking at investing in, that we're looking at operating, do we feel that is one of the best investment asset classes to survive and thrive as the economy picks back up and grows? And by the way, if you are one of the few sectors that are really doing well, just like COVID, when there were other people hurting, there was a lot of people making money, just like an 08, crash, there was people making a ton of money and other people that wasn't. You're still going to have tax consequences. And so there's an opportunity to shield and or negate some of those taxes. We're not a CPA, so check with your certified accountant on that. But all you have to do, deepbluere.com, just sign up. Give us your information. Let's have a conversation, and maybe there's an opportunity for you to be an investment partner of ours.
All right, boys. Tourstudios.com.
Holler.
That should be the tagline.
There you
You
go.
like that?
I like that a lot.
Tourstudios.com. Holla.
Holla. Oh, by the way, if you're still listening to this, go leave us a 5-star review. Spotify, Apple, YouTube, all of the above.
Everyone.
And send a screenshot of it to office@deepbluere.com. We'll send you some Deep Blue Capital swag so you can go out and tell everybody that we're awesome.
Love it.
Rep the brand, as Brian would say.
There we go.
I
56.
still need a hat, though. I'm just saying.
I know. They're not in my car today. I put them in my office.
Of course,
I'll get you one.
Of course not.
I want that too.
I know. I got them sitting on my desk at home. I'll get everybody a hat.
The only time is like, hey,
Yeah.
every time you're here, it's there. No,
I know.
it's not. He's lying.
And
to you.
now he's going to Vegas tomorrow. Right.
Yeah.
I said, next thing you know, you hawked my hat for extra slot machine money.
Yeah.
Wouldn't get me far. I promise next Thursday, if not sooner, I will get you your hat. And shirts. You got shirts coming too.
And shorts.
And shorts.
Deep blue underwear.
Bicycle shirts.
Deep
Short
blue
time.
board shorts.
Yes.
I like it.
Episode 56, boys.
In the
Appreciate
book.
you listening. In the books. Check us out next time. Bye, everybody.
Dude.